So we left off thinking about expectations. And it's pretty natural for us to think in a backwards fashion. That kind of maybe works in a couple different ways. One, realistically, and two, it's not efficient fashion. What we talked about last time with adaptive expectations. So these are backward looking, using previous information to predict what you're going to be doing next period or whatever you're predicting. So expectations formed from past experience only. So for example, just I guess to use one that would be relevant for OU would be enrollment predictions for 2015, fall 2015. So if we take the fall, if fall 13 was 580, fall 14 was 590. I guess I maybe should put in just for fun, fall 12 is let's say 585, whatever it is. So in order to predict our variable fall 15, our expected fall 15, we're just going to look at this data and say, I think I'll do a weighted average and put a little more weight on last year compared to this year, do some sort of formula. We could average all three. That probably wouldn't be maybe a great idea. So a common thing is to put a little heavier weight maybe into the one that's closer. So lots of different ways, but that's the idea. We're going to use previous stuff to predict the future. All right. Well, there's we kind of hinted at this even since we started the course, I think, that that might not be the best idea. If we start to dig deeper about what causes enrollment, what caused it to be 585, what caused it to be 580, we can start to dig a little deeper and maybe make a better prediction using some regression analysis or some other econometric method. All right, so rational expectations is the counterpart. What does it take to be a rational expectation? So a rational expectation is one that is based on all available information. An expectation that's based on all available information. What happened historically is one piece of information, but there might be other things going on right up to the time we're going to maybe make a decision. Up to that point, before we pull the trigger and say it's going to be this, we've looked at all available information. Okay, I'm going to sneak this in right now too, and then we'll talk about it. They are correct on average. And so the kind of the fancy way of saying this is that the forecast error, the expected forecast error is 0. forecast error, our expected error is 0. So we've kind of squeezed every bit of information we can on it. So to motivate this, I'm going to kind of follow the books example, which I think was pretty good. I hadn't seen it used this way, but commuting time. So what is our commute time going to be dependent upon? From the time we leave our door, traffic, right, is a big thing. What else might enter in?
You have a
Flat tire, yeah, some sort of problem comes up. So a few different things might come in, mostly traffic driven. And can traffic be counted on, predicted pretty easily? We can watch the news, we can do some things like that, right? So, but yeah, right. On average, it's probably pretty consistent. If there's, some days are going to be a little heavier than others, and even watching that stuff, it's still maybe a roll of the dice. So, let's see. So as we've been commuting to work, we've pretty much put that the long time is about 40 minutes. I'm sorry, it's 35 minutes. And if we're hustling and there's traffic's not bad, we have about 25 minutes. And it seems, sometimes it's 30, so plus or minus our average time seems to be coming in right at about. And again, we could have collected data on 30 trips to work or 100 trips to work. Sometimes it was 29 minutes, sometimes it was 30, but we have a number of observations, and then we could look at our expectations. So as we leave, we expect an average of 30 minutes with plus or minus a 5-minute differential for the most, in all likelihood. So if we draw the distribution, which by the way, if we collected more data, we could see whether that's a flat tail or a wide tail, but who remembers what this is from some other classes? The bell curve, right? What are we measuring on the vertical axis? Remember?
The times
No, it's not the amount of times. In this case, there's other ones that can make it look like that. So it's the probability. So the highest probability, in all likelihood, it's going to be 30 minutes is what we estimated. And then if we're off, we might be off at 32 minutes, or we might be off at 28 minutes, right? And so the distribution runs this way. The rational expectation part means that on average, these two are going to balance out. So the tails of the distribution are equal, meaning that it's equally likely that we'll get there quicker, or equally likely we'll get there slower. We don't know. It's a flip of a coin. We've squeezed out all available information that morning before we left, and we made our chance. So we've eliminated all bias that we might be long or short. We've collected data, squeezed out all the information.
One question. So the adaptive expectation, are these like complementary or completely adaptive?
They're, this one includes this one.
I was going to say, because I feel like the past information would have been,
Yeah.
taking all that data
Right.
and then finding the average.
That's right. So we are using past information here.
So they're one and
Right.
the other.
So, and you're right, Katie, you're kind of hitting right on. This looks very adaptive,
Yeah.
right? If I took all the previous trips and I said, what are you expecting this morning? So where rational expectations is different is the story of clicking on the news, going onto the KC, what's that app called where it's KC, maybe you guys aren't even familiar with it since we mostly live in Ottawa, but there's the Department of Motor Vehicles or whatever, the KDOT does a traffic congestion pattern, and you pull up the KC map and it's lit with all the major traffic areas with green, yellow, or red. So it tells you where traffic patterns are slow, and I think you can even say if I'm here and want to go here, how long is this route going to take me? And they kind of estimate all that stuff. So it's pretty high tech. So adaptive wouldn't take that into account.
So rational is like all available.
Yes, all available information. So this plus this. And so what makes the expectation rational is that if we do flip on the app or the news and we learn that the helicopter report tells us that there's an accident on 35, then I can immediately change my expectation from 30 to 40. And I can add on this little extra amount for the delay that I learned about. Whereas with the adaptive expectations, we don't have that flexibility. Okay? All right, so let me put that on here. So let me put it the way you brought it out here. So note, expecting 30 minutes is an adaptive expectation. But checking traffic report before leaving and learning about an accident on your route changes your expectation.
Could you say that it's more accurate to the current trend because of the current trend?
Because of the current information, not necessarily trend, but because you've used all current information. And I'll just tack on to being rational. Okay, so the notation that your book uses is this. They say, from a notation standpoint, your expectation that you make on variable x is equal to the optimal forecast. They put OF up top. So this is expectation, your rational expectation equals your optimal forecast. So some of the criticisms is whether can we take this onto that the world operates on rational expectations on average. And so what if everybody doesn't have all information? Well, we have experts that we can rely on. They make the forecast for us. We just kind of digest it. So, and why do the experts get this information for us? Are they just a bunch of Mother Teresas, or who are these experts that we turn on the radio and they tell us that there's an accident? Why are they doing it? Yeah, it's profitable to do so, right? If you're the news channel that has the most up-to-date info on traffic because we invested in this computer system that analyzes the traffic and GPS and tells you the exact minute, we've developed a real easy app, people start coming to you. People who run commercials on their radio stations start going to them, right? It's the popular one. Everybody tunes into channel 8, you know. Well, it's profitable for people to be figuring out the most efficient methods because they're the most profitable methods. So that's kind of the market system, the free market getting some good solutions for us without having the government have to provide maybe the traffic information and taking that away from taxpayers because it's a public good. Okay, now how does this tie in? Any other questions or comments there? So I want to tie this back to the stock market because this whole chapter is about the stock market. So first of all, recall what we did last time with our prices, and this actually might have been from a previous chapter, but we kind of did it this way. So the return on a stock, how did we do that last time? How did we make money in stocks? Or we might have did it last week. Dividends and the price, differential in price, right? So for the one period model, the return, and I think we wrote it a little bit differently when we were doing the price, but if we pay P T plus 1 minus PT, the price that we bought it at, so I bought it at $100 a share, I sold it at 120, PT plus 1 minus PT, and then add back the dividend payment, or the cash that came in between. So some sort of cash payment, could be a coupon payment, could be a dividend, so we're thinking of this being a dividend or cash payment. Old price, new price, divided by new price minus the old price. Maybe we got some extra cash. New price minus the old price divided by to get the return on the investment. The rate of return. New price minus the old price divided by the original price, the old price, right? So PT. So if I bought it, if the cash payment was 0, I sold it for 120, I bought it at 100, 120 minus 100 divided by 100 is a 20% rate of return. Okay? So there's our return. So R equals the rate of return in general. If we're now changing this into something forward-looking with an expectation, and we're talking about a stock with a dividend, what do we need to change to make this an expectation? Rather than being backward-looking, maybe adaptive, that I actually sold it for 120, I bought it for 100, here's the 100, and I got this much. How do I turn it into an expectation? How do I make this the expected return today moving forward? What's unknown? The price you're going to sell for, right? You don't know that for sure. So this is an expected. So we can transform this equation by just tacking on a couple E's to think about it in terms of this rational expectations framework. We did the same thing when we did the Fisher formula. What was that formula again? I think I'd pull that out of you. I minus expected inflation if we do the expected method. That's right. So I minus the expected inflation equals the R. What was that little R in that case? The real interest rate. Good. And if it's the expected inflation rate, we're forward looking. I'm a lender thinking, oh, should I charge 6% interest or 8% interest? Well, I'm going to expect a certain amount of inflation in the future. I really only care about my real rate of return, right? So I have an expected real rate of return with an expected inflation rate. I'm going to charge 8% today. So I know something today, but I'm only expecting something in the future. So we kind of did a similar thing with the Fisher formula. If we look after the fact, we can look at what was the actual interest rate, what was the actual inflation rate after we learn it. That one minus that one equals your actual real rate of return.
Wouldn't the expectation of the selling price like lead to maybe a possible overvaluation, which you could?
Here?
Yeah.
Okay, well that's where we're getting, whether it's an over-evaluation or not. In order to form this, what are we using if we're rational? All available information, right. So market participants are going to be using all available information to think about what that expected future price is. And if we're talking about what it is today at 10:30, what about what we think it's going to be at 11:30? We kind of saw that yesterday with that chart we were looking at, or Wednesday, right? So we start thinking, well, what's my expectation about what it's going to be next hour? What information's out there to do it? And I start changing my behavior. If I think it's going to go up next hour, I buy now and hold it for an hour. If I'm a day trader, this is what day trading is all about. They go in, make small little trades to be in and out of the market really fast. So why do they care so much about next hour's return? If they're right, they make money. Same thing we talked about before with figuring out what the traffic patterns are. We have incentives to turn over every morsel of information. So I want you to keep thinking about that, because as we do that, that's leading to us coming to the efficient market hypothesis. And that is that the prices that the stock market shows reflect all available information. They are efficient. They reflect the value of the company or all the information that's known at the time. We have thousands of market participants that are trying to turn a buck on stocks. Each one of them is making maneuvers, some buying, some selling, to keep driving that price to a value that reflects all information. Okay? So, let me put that in a couple little terms. So, let R star be the current equilibrium price, or return rather, return on a stock. What this efficient market business is saying is that if the optimal forecasts of that return, we're going to kind of say, suppose we're in disequilibrium basically. If the optimal forecast is greater than the current situation, are people going to buy that stock or sell it? If the optimal return, the optimal forecast of what they think it's going to do is bigger than what it's currently doing, are they going to want to buy it? Yeah, they're going to buy it. Increase in demand drives up or down the stock price? Up. An increase in the stock price leads to a lowering of that return or a raising of that return? Be careful with that one.
Is that current stock price going up, or is that?
Right, that's driving up the prices, heading the other direction, so that eventually we're going to be converging to our equilibrium where the optimal forecast equals the current price, which is this prediction here. That we're going to have an expectation that's equal to the current price, that's equal to the optimal forecast. All right, so this will lead to an increase in the price of the stock, which is going to drive down the current return of the stock in time period T.
And that price increases even.
And then we're going to be leading towards our outcome that we expect to have happen is this. we expect those two things to be equal. So we're just kind of showing the market movement towards the equilibrium. And then vice versa is true. If the optimal forecast is less than the rate of return, people are going to dump the stock. The stock price falls. Now that it's cheaper, if we actually eventually get to the price, that's going to drive up the effective rate of return. And then again, all we're doing is we're heading back to our equilibrium condition. That's where it's going to stop.
So RT is rate of return.
Yes. Here we're just kind of saying the relationship between the price. If today's price is higher, it's going to, and we kind of think about tomorrow's price being fixed. So in my 100 and 120 example, if 120 remains what we think it's going to be, but the price starts going up to 110 today because of market pressures, that's going to cause the return to fall. Okay.
What about how we had said, though, that you can't really base what's going to happen off of past data because it's changing situations all the time?
So as the new data becomes known, those prices move pretty quickly. I don't know if I answered what you're getting at, but so the argument being made by the rational expectations theory is that that current price does reflect an optimal forecast. It does reflect all available information, not just past data, right? Which allows us then to say, well, geez, this stock has been flat for the last 50 years. Why is it all of a sudden climbing? Because there was new information that came up and that started to drive it up. Okay, I got a little fun video from a site called, or a YouTube channel called NBA Bullshit. So this is kind of some basics for the efficient market hypothesis that I think will help tie us.
Hello and welcome back again to MBAbullshit.com. So the topic for this video is the efficient markets hypothesis, also known as EMH. And this is the basic video before we move on to a more advanced video on the efficient markets hypothesis. Remember, you can always go back to MBAbullshit.com. Alright, so let's get down to it. Now before this video,